welcome to BloombergQuint. The budget presentation from Finance Minister Nirmala Sitharaman certainly cheered the equity markets. I think they got the growth supportive budget that they were looking for without any big howlers on the tax front. But of course, the consequence of that is wider fiscal deficit in FY21 and FY22, which left the bond markets in a sulk. Joining us for his views on what he made of the budget, Jahangir Aziz of JPMorgan. Jahangir, thanks so much for taking the time to speak to us. Jahangir, we got that belated sort of fiscal boost. I remember we've spoken during the last few months, and you were like, why is India being the epitome of fiscal sort of rectitude? And they've corrected that in one shot in some ways.
Right. It was very heartening to see, at least, starting from around October and then, the pace moving up in terms of government spending. But at the same time, if the government is only willing to spend when revenue is growing, then essentially what you're doing is opposite of what a government should be doing. So instead of providing counter-cyclical support, you are actually becoming pro-cyclical. The revenues are growing because the economy is growing, and that's exactly the time when you're adding to the recovery or to the pace of recovery by spending more. It would have been much better if the government had actually started spending in the 6 months prior to that, when revenues were actually falling. But be that as it may, I will take whatever I get. So I'm reasonably, okay that at least the government is spending money rather than trying to focus way too much on trying to, keep the fiscal for the budget numbers from blowing up.
Jahangir, one part of the FY21 numbers, though, does seem to be a little bit of cleanup of the previous budget. So, what is being reflected as a 9.5% fiscal deficit or a 17.7% expenditure as a percentage of GDP number is perhaps actually not that large in real terms.
No, it isn't. No, it isn't. The fact that, in the past years, if you look back, and something that, we have continuously pointed out that this is not the way to do a transparent budget. A very large portion of food subsidies, for example, used to be essentially funded off the budget by Food Corporation of India going and borrowing outside of the budget. I remember, 2-3 years back, that number was close to about 2% of GDP. Of course, it has come down. It came down to about 1% of GDP in fiscal year 20. But in fiscal year 21, they have, and I think the government should be lauded for that they decided to bring that portion, or at least some of that, onto the budget. Again, we are still going through the budget documents. It isn't very clear as to exactly how much of FCI borrowing they have brought back, but it would be very good if the government actually brought back the entire off-balance sheet borrowing onto the balance sheet, because look, it doesn't really make anyone convinced that the budget deficit is not what it is, because ultimately we all shift to the public sector borrowing numbers because of these problems. So at least the government is being transparent about it. So yes, I agree with you that in reality, it is not a 4.5 or 4.6% of GDP going to 9.5. The reality is that it's much closer to about 2 percentage points of GDP of expenditures going up. So if you take out interest rates and subsidies, spending just went up by 2 percentage points of GDP, and there's probably about a 0.5% of GDP of decline that has taken place in revenue, which we think is an underestimate. Because they are essentially not taking into account the fact that revenues have actually increased significantly in the third quarter of the fiscal year. And if that pace continues, most likely we will end up with a 9% of fiscal deficit, not 9.5%. And that would mean that overall, the only real increase in spending has probably been about 2% of GDP, with nothing really much coming from any kind of serious revenue decline.
So next year, Jahangir, help me understand how it stacks up. Expenditure as a percentage of GDP remains relatively high. 6.5% fiscal deficit, 6.8 is better, higher than what the market was expecting. So fiscal policy remains pro-cyclical. We don't get into the same situation as we did post the global financial crisis? No.
Actually, fiscal policy actually turns counter. Continues to be pro-cyclical in the sense that we are sort of looking at the budget, and we are looking at and we are providing less stimulus once you take into account the fact that that 3 percentage points of 2.7 percentage points of increase, which is most likely going to come down to about 2.2, 2.3 percentage points of increase in fiscal deficit. Almost all of that is driven by an increase in privatization, an increase in revenue, and a very large reduction in subsidies. So X interest payments, X subsidies, spending as a whole comes down by 0.5% of GDP. So given the fact that we are sort of confused about subsidies, exactly what went where, let's just remove subsidies completely. Interest payment has nothing to do with government policy. So take out those two things, then the spending amount goes down from around 10.8% of GDP in this fiscal year to 10.3% of GDP in next fiscal year.
Okay. So that leaves us in a position where there will be some government spending support. But I was trying to sort of draw a comparison to what happened in the post-financial crisis period, just to sort of rule out the possibility that we will see loose monetary policy, loose fiscal policy, and hence the problems that we saw in terms of inflation, twin deficits, etc.
No, all of that can happen. I'm not saying that can't happen. But at this point, when you look at the budget, the spending numbers are actually lower in terms of shares of GDP going from 10.8 to 10.3, and of which capital expenditure rises by minuscule 0.2% of GDP. So there it still remains the tail risk. So I think overall, the budget did manage to allay the fears that India would go in for an excessive fiscal tightening, excessive fiscal rectitude. It didn't go. I think that fear was allayed and the stock market reacted to that. But if I step back and ask, what are the tail risks facing India? I think the biggest tail risk that is facing India is, despite the very strong recovery that we have seen in the second quarter and the third quarter, which of course, given our very antiquated growth numbers, which always do year-on-year comparison, you just can't make out to it. If I look at the underlying the growth numbers, what is it that the economy looks like? And people have talked about it in terms of K-shaped recovery. What really people are saying is that the imbalances in the economy have widened and widened significantly. In particular, the scarring in the labor market is massive. If you look at private sector surveys, government doesn't have labor market surveys. We are still running around 18 million job losses. If you look at just last quarter, third quarter of calendar year 20, when we do have data, and you look at minus 7.5% decline in growth, and then you juxtapose that against the fact that the RBI came up with listed companies' profits going up by 30% that quarter. It means that the non-listed company part of the economy, made up of households and SMEs, must have declined significantly if the average decline was minus 7.5% and listed companies grew by 30%. If you have that kind of income losses, that kind of scarring in unemployment, apart from the medium-term impact on inequality, poverty, gender gap, because disproportionately the biggest impact or biggest decline in employment has been the services sector, which we do know is dominated by women employment rather than male employment. So apart from all of these other things, there is a fear that if you, with these kinds of income losses, will have impaired household and SME balance sheets. So let's move forward 6 months. Vaccination rolls out. No, there is a normalization of activity. That's when all the spending starts. SMEs then start on the back of those large spending by listed companies and the government. SMEs now start to get contracts. They go to the bank for working capital. But at that point in time, their balance sheets may have been impaired so much that banks essentially no longer provide them with credit. Yeah. And so, there is a tail risk that all of this recovery that we are seeing could end up being a dead cat bounce. Okay. And I think that tail risk, the budget does not address at all. The budget essentially allays fears that we are not going to have a massive tightening of the deficit, the taxes are going to be raised and things like that. But the tail risk, that remains, that this could well be a dead cat bounce.
Jahangir, rightly or wrongly, there is still the lingering fear that a relatively high debt to GDP ratio, also a
Sure.
glide path on the fiscal side, which is only taking us to 4.5% going by the budget speech, that could spur some sort of rating action, that could spur nervousness among foreign investors. In this kind of environment, do you think that concern is justified given what's happening world over?
I think that it is something that we should keep in mind, but for different reasons. So if you go back to April, right, when the two rating agencies issued their own views about India's ratings, one of them went down from one notch higher than investment grade to investment grade, but they downgraded. The other one kept outlook stable. So if you look at the underlying numbers that both rating agencies had, all the numbers at that point in time in April were identical between the two of them. The only difference was that one rating agency had 1.5 percentage points lower nominal GDP growth over the medium term for the next 5 years, and the other had 1.5 percentage points higher. The one that had a higher nominal GDP actually kept the outlook stable. The one that had a lower nominal medium-term GDP downgraded it. I don't think despite what the economic survey, etc., did write about, rating agencies are not going to look at 2020 and 2021 and say, you know what, you shouldn't have spent money. You should have been fiscally disciplined. You know that this was a pandemic. This was a once in 100-year shock. The question is, what kind of fiscal policies did you adopt during these two periods to ensure that over the medium term, you went back to your pre-pandemic path? And if India's fiscal policy and monetary policy and reforms, etc., whatever you look at it, does not assure rating agencies that India is going to go back to the pre-pandemic path over the medium term, then every fiscal indicator that we look at, debt to GDP ratio, debt sustainability, all of those things, ironically, will actually worsen, despite the fact that we did not really spend that much. And that's when the de-rating risk comes. It has to do with medium-term growth. It has to do with what these guys believe is going to be the interest rate going forward, what is going to be the growth rate forward, what is going to be the gap between interest rate and growth rate. And that's where, as I said, comes what the tail risk comes into play. That if this recovery does not go through, look, to be honest, we have 13.5% in fiscal year 22. Even with 13, which is obviously higher than the government, higher than what the market consensus is. Even if we get 13.5%, we are still going to be in level terms about 5 percentage points of GDP lower at the end of fiscal year 22 in level of income. If you average the loss of income, it's about $200 billion per year. It's a serious reduction in the level of income. And I think that's what the rating agency will look for. Does the level of GDP go back? And how quickly does it go back to the pre-pandemic path? And if that doesn't happen, yes, all the medium-term fiscal indicators turn down, and that's when we get a de-rating risk.
Jahangir, a word on some of the other sort of headline announcements, the intention to set up another development finance institution coming full circle, the announcement that they'll privatize 2 PSU banks. Markets have taken that as a signal that they are moving in that direction. The bad bank, although, is iffy because they've said that this is going to be a bank-promoted ARC, which to me is no different from everything else we have in the market. But for what it's worth, I think the equity markets have taken all three together and said that this is the right direction.
Each one of them by themselves, we've probably tried some version of that in the past, right? It isn't that this is the first time we are thinking about Development Finance Institute. We tried that in the 1960s also, and it didn't quite turn out the way we thought it was going to turn out. We have tried privatizing banks. Look, at the end of the day, we have an issue with raising long-term financing. This is not a 2021 problem. It's been there for the last 40, 50 years. The issues have all remained exactly the same. These are not issues that have just cropped up. It is the inability of the market to be able to price long-term risk that has to do with twofold. One has to do with the manner in which our private-public partnership contracts are actually arranged, and therefore a large part of that depends on how PPP projects are actually contracted, and there needs to be reform there. And the other is that we have, Asia, like other countries in Asia, we have, a pretty weak, on the face of it, a very weak long-term corporate bond issuance market. I mean, this is not a new problem. There is a lot of primary issuance. There's hardly any secondary market trading that takes place. And the answers to that isn't really creating a new public sector development finance institute. What really needs to be addressed is A, those infrastructure project contracts, and B, how do you get corporate debt, especially the long end, basically funded by the capital market, and that requires capital market reforms. So yes, I mean, development finance will probably, raise some capital. We could see some, excitement in the market. But again, they are not addressing the actual issues that have been the case in India for the last 20 years.
No, absolutely. Jahangir, last word on where this leaves the RBI. Tough spot for them. Borrowings remain high next year, and I think the states are being allowed a fiscal deficit of 4% in the next year as well, if I caught that. So broadly, borrowings remain high. I don't know if they have the kind of sort of justification that they had this year for extreme surplus liquidity, and that old conflict of debt manager versus central bank perhaps may come back.
Look, I mean, that's been, again, these are again not new things. I think in the, I think in the pandemic, we sort of set it aside, right? We said, okay, fine, let's not worry about that. But in fiscal year 2022, the chances are very likely that the RBI will probably be forced to do more QE than what they did in fiscal year 20. The struggle between inflation targeting, growth support, and being the debt manager of India, of the government, and trying to keep the exchange rate stable will again come into the fore. It will take various versions, but my sense is that, look, the RBI is unlikely to let the 10-year yields go too north. They will intervene. They will do a significant amount of QE, and they will keep that lid down. So I'm not really that worried that on the face of it, you're going to see a massive blow up of the 10-year yield. It's most unlikely to happen. The RBI is fully aware of that and will basically use massive amounts of QE to keep it down. So again, this is going to be a year in which what becomes important from a monetary policy point of view is probably not going to be rate cuts. We probably might see a rate cut or two, not rate cuts. It is going to be what they do on quantitative easing, and probably something that we don't discuss because it's hard to discuss that, is what they do on regulatory forbearance. There's a massive amount of regulatory forbearance currently at play. When is the time when the RBI says enough is enough? I'm going to go back to what used to be the situation before, and that's on accounting rules, that's on capital requirements, that's on provisioning, and when that happens, I think that is the time when we will see NPLs rising, and hopefully the RBI will pace that decision to lift forbearance, regulatory forbearance, steadily, so that the market doesn't get shocked when that happens.
All right, we'll leave it at that, Jahangir. Thanks so much for taking time on a busy Monday to speak to us on BloombergQuint. Thanks.
No problem. Sure.